Hello, I'm Ken Leon, Director of Equity Research at CFRA, and today we're going to talk about the U.S. diversified banks, the 2020 outlook with COVID-19. Certainly, coronavirus brings uncertainty to everyone's lives, the global economy, and financial industry. And CFRA's analysts and strategists remain focused on delivering exceptional research insights to help investors stay up to date on the latest market developments. The impact of coronavirus is affecting all industries, but for the diversified banks that just reported this week, we see significant milestones. First, we're in recession. Banks' non-interest income will be affected by weak market conditions, hurting both the consumer and commercial loan activity. Interest rates is an important part for the large banks in terms of income, representing 50 to 75% of total net revenue, and the unprecedented moves by the Federal Reserve Bank to avoid depression means low interest rates in 2020 and 2021. We've also seen a seismic shift in terms of focus both for the bank managements and investors to credit quality risk. This shift is looking at borrowers' capacity in terms of liquidity and solvency to stay in business. Ultimately, it leads to what banks must do in terms of credit risks is looking at non-performing loans and leasing for ultimately bad loans. And there's so much to cover in the banks. We wanted to focus more on the commercial side today, and in particular, commercial real estate and other distress industries, which we think are going to be significant over the next few months. Looking at the 2020 outlook of what matters, it's incredible. When we looked at the outlook with our predictions back in January, I don't think any of these factors are still in place. It has changed dramatically. When we look at economic drivers, recession is likely to be deeper and longer than we ever expected, and perhaps into a 2021 recovery. The V-shaped recovery seems unlikely, and the impact of COVID-19 has created a lot of discussion in terms of a V, U-shape, L-shape, or hopefully not the cause and effect if there's a second rise of COVID-19 to a W. So let's leave it at that, essentially, as we're going to be in a weak market. Goldman Sachs actually is looking at the economic output only being half of where we were for most of 2020. Key business drivers, clearly bank loan volume activity has declined sharply from recession, and the lower rate environment, as noted before, really doesn't help any of the metrics for net interest income. These external factors, obviously, the unparalleled significant unemployment and the likelihood of rising failed businesses, perhaps even with the policy changes that we've seen. The Federal Reserve moving to defend the U.S. economy with their programs to the capital markets, and then, of course, Congress bringing sizable stimulus programs to aid business and consumers. As investors, let's take a look at price performance comparisons. Here's the one-year performance, and banks for part of the back half of last year were outperforming the S&P 500. You can see that in 2020, and especially with the downdraft in March, that the diversified banks, these are the largest banks and regional banks, continue to underperform the S&P 500. Here's a 10-year snapshot. The green again is the S&P 500, and again that you can see for 10 years that bank stocks really haven't done that well, lagging the S&P 500 for some time, but they're a meaningful part of portfolios, and clearly, you know, we think there's always room for banks in a portfolio, and we'll get to that. Let's talk about bank credit risk. This is top of mind. It was clearly most of the attention for investors is about what is happening in terms of bank assets and liabilities. So this is a fundamental snapshot you can see here, where on the left side is the assets, the real estate loans, commercial, consumer, the financial intermediary loans, and then of course the buildup of reserves, which is a big part of today's conversation. Liabilities, again, are important because this is the underpinnings of their capital, and deposits come in all different types, but they're a key part for banks. Let's move into a little bit more analysis. This is for all FDIC banks in the US, and this chart is actually for the largest banks, greater than 250 billion. That's less than 10 banks out of 4,000 in the US, yet they have 55% of the total assets of the industry. Here we're looking at non-current loans and leases. And you can see, looking at history to the financial crisis and the Great Recession, that there was a sharp increase in this ratio of non-current loans. In fact, it was 7.4% back in the fourth quarter of 2009. And we started 2020, finishing the end of last year, below 1% on this important ratio. What this will look like as we go into the second half of next year might be something similar to what we experienced back in the period 2008 through 2011. Another example here is really looking at bank coverage ratios, or the loss allowance to total non-current loans and leases. Recession leads to a lower coverage ratio of loss allowances, which we see, and it stretches further as we see that we really didn't hit bottom until 2013 at 45.7%. And today, the loss allowance is 125, 130% in 2019. What this means is essentially banks are conservative, they're building up their reserves, their loss allowances, and then in time, depending on what happens with banks and with commercial and consumers, we begin to see the rise of the denominator of the non-current loans and leases. Non-performing assets to total equity, another snapshot, and you can see here that back in the Great Recession, there was a sharp increase. This is for the 4 largest banks. And you can see here that there is differences in terms of the credit quality that they apply. JP Morgan, it's interesting, and the ratios here were always performing better than some of the other banks. The conditions of their balance sheets, their loans, were vastly different today. And we could see that as we moved further away, even with 2012, with the implementation of Dodd-Frank and the annual stress tests, most of these banks have moved to really strong position. But I would say that the first quarter results, the banks took almost $23 billion of new provision expense to their reserves. What's different today than where we were in the Great Recession a decade ago? Importantly, banks are in better shape. They have sizably more capital. The ratio of net loans to deposits is much better today versus a decade ago. This gives them strength and the ability to have endurance into such a sharp recession that we're beginning to enter. Here again, before the financial crisis, 2006 into 2008, we had this ratio where loans were over 100% to total deposits. Today, those ratios are in the 70% range for Bank of America, Citigroup, and Wells Fargo. JP Morgan, at the end of the first quarter, it was actually 54%. And if you look at the gray line here, you can see that JP Morgan had much more discipline in terms of their loan risk, staying below 70%, really back over the last 10 years. Here again, we want to take a closer look. I mentioned there's so much to cover, and we wanted to focus on commercial loans and commercial real estate. And what you're looking at here is the lines of credit for real estate, both the unused commercial real estate lines and the unused unsecured lines as well. Very often you hear about the drawdown to your lines of credit. Large companies like Boeing tap that very quickly. We're seeing distressed industries do that quickly as well. But it gives you the magnitude here in terms of these lines of credit. So obviously we have been in great times since 2012, and there's been a fourfold increase in terms of real estate lines of credit ending 2019 versus the low back in 2011. Commercial real estate loans, though, for lessons learned in terms of how sharp the curve can be to net charge-offs, looking back to the Great Recession again, that orange line, you can see the steepness of the curve, and that moved to just under 3% for charge-offs. Today, it was almost at 0% at the end of 2019. We would bet that this orange line is going to move sharply higher again to total versus over commercial real estate loans for 2020. Here's just a broad snapshot again. So when you look at these four large banks, the commercial loan exposure ranges from 47 to 56%. The types of loans that they have, of course, again, are also dependent on what industries that they make loans to, the geography that they're involved with. And this is just to give you context to the magnitude of total commercial and industrial loans. When you look at the commercial loan mix here, you can see that real estate really is not a large percentage of the total commercial loans, but we think it's one where there could be greater weakness in the near term than broadly all of commercial and industrial loans, Xing out, of course, some distressed industries. Now, when you look at these four banks, it varies. JP Morgan and Wells Fargo on real estate, it's about 25, 26% of their total loans, whereas for Citigroup, it's 12%, and Bank of America, it's 16%. Another factor that we think is important is that real estate, commercial real estate, is really linked closely with the commercial mortgage-backed securities market. And here you can see that the different property types where we've seen CMBS issuance. This is just for 2019. This is a market of over 1 trillion. And what's interesting here is two things. First, we have some very cyclical sensitive properties. Obviously, hotels because of COVID-19, office, everyone is working from home, retail. These are probably the most exposed or vulnerable to COVID-19. Industrial is probably a little more stable with maybe greater investment ahead because of e-commerce. And then, of course, multifamily is a little bit more defensive. Another interesting aspect about the CMBS market is that we've had some major announcements and programs from the Federal Reserve. But it's interesting, they are backstopping the high yield market, but for CMBS, they're only backstopping AAA investment grade tranches. So below that, which is where most of the issuance happens, could be at risk. Here's another example of wholesale credit exposure by industry. We happen to take here JP Morgan Chase, which we've noted has been great on credit risk. But what happens? So real estate is their largest industry exposure, and the top 5 industries for JP Morgan Chase on the commercial side represent anywhere roughly 47% in total. But then we got a moving picture here in terms of what happens in terms of delinquencies and the credit rating agencies moving more from investment grade to non-investment grade. And then, of course, another snapshot that we could have showed you is looking at all the banks in terms of what are debt maturities in 1 year 1 to 5 years, and thereafter. In debt maturities in 1 year, it's typically 20, 25%, and in 1 to 5 years, cumulatively, it's 2/3. I want to finish up and talk about our recommendations, CFRA stars, for the diversified bank sub-industry. Mostly because of the sharp sell-off of the market and the banks, we still think banks are part of the solution. They are not the problem like we saw in 2008, 2009 with the financial crisis. CFRA also believes, importantly for investors, cash dividends are secure for the largest US banks. These banks have also put a moratorium on share repurchases. And when you look at return of capital, which has been sizable in the last few years, cash dividends only represent 15 to 20% of return of capital. Yet for many investors, that dividend is very important. And the managements have put a strong stand to Congress and to the market saying that we stand by the cash dividends. We also believe, as we showed you, the size of their deposits and the strength and increases of their capital, that diversified banks can endure a severe recession in the near term. Well, what do you mean by the near term? We are thinking 3 to 5 months. If we are to see an L shape well extended into 2021, then our discussion here in terms of credit risk and the magnitude becomes even greater. Importantly, though, it always gets dark before it gets light. And with investing, I want to point out that bank stocks are cyclical. They're out of favor, yet any green shoots or signs of an economic recovery, we will see opportunity with investing in bank stocks. Today, we believe that there's an enhanced buying opportunity with the steep decline in bank share prices. We have buy recommendations on Bank of America, Citigroup, JP Morgan Chase, and a hold on Wells Fargo. We think these banks are well positioned and they can endure the recession that's going to be ahead and all the aspects of the cycle as it relates to credits and charge-offs. So with that, to get more information about our thematic research, both on the banks, but also our thematic research on COVID-19, you can look to MarketScope Advisor. Thank you, be safe and healthy, and have a good day.